Hi, let us understand what is market linked debenture and how does it operate. A market linked debenture is a debt instrument through which any corporate or an NBFC raises money from the market. The returns that you get on a market linked debenture is dependent on the performance of the underlying index or a stock or a commodity that it is linked with. So if you invest in a Nifty linked debenture in say next 2 year, 3 year, based on the performance of the Nifty, you get your returns. Market linked debentures can be of many characteristics such as principal protected market linked debenture versus non-principal protected market linked debenture. Let me give you an example. If you invest in a Nifty linked debenture which has a starting point of let's say 18,000, it's a 2-year investment. Say it says that if the Nifty grows another 30% in 2 years time, you will get say 1.3x or 1.4x of that, which is known as a participation, that you get 130% or 140% participation. Suppose the Nifty value at the end of the 2-year tenure is lower than 18,000, that means Nifty has generated negative returns. So if you would have invested in an MLD which is principal protected, then in that case you don't lose part of the face value of the debenture that you invest with. So that works like a principal protection for your capital. If the same instrument was not to be a principal protected instrument, then the loss that you have on your investment, say typically similar to the index loss, right? I mean, whatever index loses, you also lose that value. This is the one of the important characteristics in terms of principal protection versus non-principal protection. The market linked debentures could be rated versus unrated also. That means the rating could be done of the instrument by the credit rating agency. They can be listed or unlisted also. A listed debenture is typically listed into a debt segment of Bombay Stock Exchange or the National Stock Exchange. When an issuer offers principal protected market linked debentures, let's understand how does the issuer ensures that there is a principal protection in place. If you invest say 100 rupee into a market linked debenture issued for a 3-year tenure with principal protection, and let's say it is linked with Nifty 50 index, saying that if Nifty goes up another 50%, you will get 1.3x of that. That means if Nifty goes up really 50% in 3 years time, you get 65%, which is 1.3x, 130% of whatever Nifty delivers. So typically, to ensure that there is a principal protection achieved, how does the issuer ensure principal protection? When you invest 100 rupee in a principal protected market linked debenture, on 70 to 75 rupees, the issuer will try to generate fixed return. So let's say if 70 rupees is deployed at say 12.5% rate of interest for 3 years, it will become 100 at the end of 3 years. So that ensures that the principal protection is in place. The remaining 25 rupees is used for investments into Nifty derivatives, which will actually generate Nifty linked returns. So at the end of the 3 years, if the Nifty index is lower than where it started, let the 25 rupees become zero, but the 75 that has been invested or lent out by the NBFC at 12-13% rate of interest will become 100 at the end of 3 years, and that will be used for protecting the principal amount that the investors have invested.